Good afternoon and welcome to today's Netwealth webinar on the spring statement. My name's Tom Kimchi. I'm the head of advice here at Netwealth, and I'm joined today by Dr. Gerard Lyons, our chief economic strategist. And today we're going to be talking about yesterday's speech from Rachel Reeves, some of the implications macroeconomically, looking at the growth picture. And there weren't actually many personal tax considerations or potential tax changes, but nonetheless, we'll talk about some of the changes announced at the most recent budget, and we'll talk about some of the tax year end considerations, although there's not much time there. And finally, we'll talk about some general financial planning considerations and what you might want to think about as we approach the budget later this year, the fuller budget. So we've had lots of questions in. We'll try to cover as many of those as we can throughout the session today. If you have any more in-depth personal questions, certainly feel free to send those into advice@netwealth.com and we'll do our best to get back to you and answer those. First, I'm going to pass over to Jerry there, who's going to start by talking a little bit about the growth picture, I believe, which is a big focus.
Thank you, Tom. Well, thanks for joining. Yeah, the key message really from yesterday's spring statement was that after a weak growth picture this year, the independent forecaster, the OBR, expects the economy to rebound in future years. Despite that, the debt picture still remains very high, and thus the economy is very fragile and vulnerable to any shocks, whether overseas from America with tariffs, or indeed if growth disappoints here at home. So I, like indeed many forecasters after yesterday, think that yesterday's events are a prelude to the budget later this year, when some tough decisions are likely to have to be made. But let's put this in context. Let me talk about why we were where we were yesterday, then about the growth picture, then about the implications for debt, and then what that does mean for later in this year. Now, the Chancellor, Rachel Reeves, last autumn, when she delivered her budget, moved us to one fiscal event a year. That meant that she wasn't expecting to give any other major fiscal events through the year up until October, probably this year. But the OBR is obliged by Parliament to release an updated economic forecast at this time of year. And the OBR's new forecast points to growth being weaker this year, inflation being higher, and borrowing costs higher than expected last autumn. As a result, the Chancellor was obliged to actually respond to that. That's because last autumn she basically stuck with and indeed strengthened her fiscal rules. Now, fiscal rules sound like a great thing. They're there to tie your hands behind your back in some respects. Now, maybe she needed to have these fiscal rules to keep the left of her party under control. At the same time, she was keen to avoid being criticised for being a Liz Truss by getting the fiscal finances into a difficult position. But the bottom line is that last autumn, she came out with one major fiscal rule and two minor fiscal rules. The major fiscal rule was that she wouldn't borrow to fund current spending, but the headroom was only 9.9 billion. Of the other two fiscal rules, one was that she would keep debt under control, and the headroom for that was just over 15 billion, 15.7 billion. And the other fiscal rule was to keep welfare spending under control. So she left herself with very little headroom. Now, those figures, 9.9 billion in particular, sounds like a big figure when you see it on the front page of a newspaper. But when you think of it in relation to an economy like Britain, that's about £3 trillion in size, or in relation to government spending, which is already over 1.3 trillion, you can appreciate that 9.9 billion is small, is only 0.3% of GDP. Therefore, because the OBR was changing its economic forecasts, that would have meant that if the Chancellor had not done anything, she would have broken her fiscal rules. Hence, she came back to Parliament yesterday with a whole suite of measures. Now, she didn't call it a mini budget, but when you look at the Treasury document that came out, there were 31 lines of changes. These were all on the spending side, not on the tax side. So to all intents and purposes, it was a mini budget. But she took measures, cutting departmental spending, or the growth of it, cutting the growth of welfare spending, some further measures on tax avoidance, and there's an assumption about productivity improving, all of which allowed her to actually pull her fiscal rules out from being missed, and she came out with new fiscal rules. Bizarrely, strangely, oddly, her new fiscal rule is exactly the same as last year in terms of its headroom, £9.9 billion. And her debt fiscal rule, whereas its headroom last year was £15.7 billion, is now £15.1 billion. This naturally leaves people to think, is this back to front policy making? You're making policy to get your fiscal rules being met. So that's the background, and that explains why we saw what happened yesterday. Now, let me put a bit more meat on the bone, so to speak, by going through the growth numbers. I'll go through the debt figures and then the outlook after. But let's call up some slides. This is slide 1. And this is from the OBR's document that came out yesterday. On the left-hand side is economic growth forecasts from the OBR last autumn and from the OBR yesterday. And on the right-hand side, which I'll come to in a moment, is their forecast for productivity. Now, on the left, the lighter, I'm colourblind, so this never helps, but the lighter colour one is what the OBR was saying last autumn. And they've cut their growth forecast for 2024 from 1.1 to 0.9%. And they've cut significantly their growth forecast for this year from 2% to 1%. Now, part of this is self-made. Last autumn, ahead of the budget, the Chancellor and the Prime Minister were very downbeat. Confidence took a big knock. Whichever economy you're in, whether it's Britain, America, or elsewhere, the outlook depends on the interaction between the fundamentals, policy, and confidence. And you can't predict confidence, but if confidence is lost, then people stop spending, investors stop investing. So confidence suffered ahead of the budget. Then we had some big tax increases announced last autumn. It was a spend, tax, and borrow budget, remember. Many of those tax increases come into effect next week on the 1st of April. But nonetheless, they had an impact at the end of last year. And that left the economy vulnerable as we moved into this new year against the backdrop of the changes being impacted in the States and the uncertainty in the financial markets. So the OBR thinks that much of this reduction this year in growth forecast from 2 to 1%, 2/3 of it they think is due to cyclical factors, and therefore that will lead to a rebound next year. And so if you look at those other figures, next year, 26, 27, 28, 29, the OBR, bizarrely for some people, is more upbeat than they were last autumn. So much so that the most surprising figure yesterday, and you can get excited about figures, forgive me, is that in 4 years' time, at the end of this decade, the OBR thinks the economy will be £66 billion bigger in size than they thought last October. So they are quite upbeat. And part of the reason is shown on the right-hand side. This is productivity growth. This is where the OBR is really different to the consensus. In terms of their economic forecast for this year on the left, they're now in line with the consensus. In terms of their economic forecast for next year, they're more upbeat than the consensus, expecting 1.9% next year versus a 1.3% from the consensus. But on the right-hand side, they are very upbeat about productivity growth. They think the trends for productivity growth, which is those numbers, that line going up to the top right-hand side, will be far faster than what one has seen recently. If they're wrong, then the OBR will have to start to change their forecasts, which will have a big impact in terms of the Chancellor possibly later this year and more particularly next year. So the first key message is their growth picture was upbeat. Now, one of the reasons they became more upbeat is that the planning reforms that the Chancellor is pushing through will boost house building. Those planning reforms are what most economists would call a supply-side measure. What the OBR hasn't factored in, though, is some of the changes that are imminent, particularly in terms of employment rights. And many small firms claim that that will hit them particularly hard. So it's quite possible as we come back in the autumn, the OBR, having factored in the positive impact from planning reforms yesterday, may have to tweak their forecasts because of some of the changes the government's enacting elsewhere. Let's move on to the debt picture. Now, the challenge in the UK is that the UK is a high debt economy. Sorry, let's go on to the next slide on inflation. I was pushing through quickly on the inflation figure. I should have mentioned these. Inflation didn't really figure too much in the forecast yesterday, but I should mention those because they do impact how the market sees things. On the right-hand side, just to say, the OBR's inflation projection for this year was that inflation is going to be 3.2% this year. Last year, they thought inflation this year would be 2.6%. So they've upped their inflation forecast for this year, but they expect inflation to move back into line with the target in future years. And that's very much seen on the right-hand side. Hence, on the left-hand side, they factored in that borrowing costs will be slightly higher than they assumed last autumn. So the backdrop of being more cautious about growth this year, inflation being higher this year, and those borrowing costs being slightly higher than they expected last year meant that they had to basically say to the Chancellor, you need to take action to meet your fiscal rules. Let's move on to the debt picture now, and I'll move on to 4 slides here. Let's go on to the next slide because this sets the backdrop. I'm going to show you 4 slides on debt, on spending, on tax, and basically where we end up being. This is the budget deficit. The budget deficit as a percent of GDP is shown on the vertical axis. During the pandemic, which is a couple of years ago, naturally the budget deficit went through the roof and is now falling. And the OBR, the shaded area on the right, is their forecast for this to keep on falling in coming years. Remarkably, only 7 years since the mid-60s has Britain actually run a budget surplus. Every year, we tend to run a budget deficit. And what is probably worrying in my mind is that given that the OBR is upbeat about growth, they still have a pretty high budget deficit as you look through the next few years. Why is that? Well, it's partly because Britain is still a high spend and in turn, therefore, a high tax and high borrowing economy. Let's move on to the next slide, which is about government spending. This is a sort of complex one, but on the left-hand side on the axis is government spending as a percent of GDP. And as you can see, we go back to the early 50s. After the Second World War, it was coming down. Then it hovered about a lot. And as we moved into the sort of latter part of the last century, it became accepted that somewhere between 35 to 40% for government spending as proportion of GDP is a norm. What we have now, and this is where the lighter bit meets the shaded area, is where we currently are. And that is basically that we're seeing a very difficult backdrop in terms of the whole fiscal position in terms of public spending. It's not really been brought under control, and it's now basically expected to remain high for the foreseeable future, around 45% of GDP, which is a high figure. That's partly because of the legacy of the pandemic, which saw a big increase in public spending. And we're now likely to see increases because of defence spending, up from 2.3 to 2.5%. That's funded by cutting the overseas aid. But if the government commits to increasing defence spending to 3% in the next parliament, as they indicated yesterday, then that will mean that another £17.3 billion of spending has to be found in 2030 onwards. So the backdrop, however you look at this, is that spending is high. And that leads on to the next slide, which is tax. This is the tax take. And is that the right one? I can't see it from here. Tax is trending up, and the tax take is very high in response to the spending increases. And then we move on to the next slide, which is basically where the overall level of debt is in the economy. And this is the real worrying one. The vertical axis on the left-hand side is 100% of GDP. Now, the G7 countries, which are the 7 industrialized countries, are pretty much all in the same boat. 6 of the G7 countries have very high levels of debt. The 7th one was Germany, but recently, as you know, is committed to increasing its debt level to pay for defense. So we're all going to be in pretty much the same boat. When your debt gets to above 100% of GDP, if growth is weak and the borrowing on the debt is very high, then you need to start running a primary surplus after you take account the government interest rate payments. We don't do that very frequently. So the real worry is this, that even after the assumption yesterday of a pretty solid growth outlook, not this year, but in future years, we have debt high because spending is high. We have taxes already high, and we leave ourselves vulnerable if anything goes wrong. When you look at debt, there are 6 ways out of the debt problem: grow, reform, austerity, tax, borrow, inflate. Now, inflating the debt away isn't really an option. The Bank of England, to some extent, did that over the last 15 years when they printed money. But let's assume that's not likely. So then you come to the other 5. Growth. That's the ideal. But the growth picture is not great. Last autumn in the budget, the Chancellor announced big plans to boost investment. But those plans don't come through until 5 to 10 years ahead. The immediate growth outlook has the economy growing around 1.75% over the next 5 to 6 years, which, as I say, is more optimistic than the consensus. So growth is the real answer, but growth isn't likely to be strong enough to get debt coming down. Second, reform. Reform the public sector in particular. Easier said than done. It will take time. The government is committed to cutting public sector employment. But it's not just in the public sector, it's across the private sector that we need high productivity as well. So growth, reform, growth isn't really there on the scale needed. Reform will take time. So you come down to the other options: austerity, tax, or borrow. Austerity is very difficult. But what we are going to see is the comprehensive spending review this summer. And the Chancellor yesterday tweaked some of the numbers here. Departmental spending is set to go up in real terms by 1.2% per year. But the non-ring-fenced areas, say justice or other areas, are going to see their budgets squeezed. Hence, some people talk of austerity already. Tax. The tax take is already very high, but there will be talk ahead of the budget about further tax increases. Or borrow. Borrowing is already very high. So where does that leave us? It leaves us after yesterday, where the Chancellor has basically said, I've done enough to get my fiscal rules back to being met. We now have a prelude to next budget in probably October, could be November, that could have the danger of being like last year. Last year, if you remember, ahead of the budget, people started to worry, started to rein in their spending. That could happen this year if people become cautious because the economy is hit by global events, or because people start to be told, because of the fiscal numbers, the Chancellor will have to take action in the autumn. Some mitigating factors will be that the Bank of England has the ability to cut interest rates. The Chancellor yesterday was keen to talk about the fact that there have been 3 rate cuts since Labour won power. Interest rates could fall down to 4% by the end of the year. Inflation is 2.8% on the latest data, set to rise before the end of the year, but a lot does depend on gasoline prices and what happens to service sector inflation. But in all likelihood, we will have interest rates being cut down to around 4%. If they're not at 4%, they're likely to be lower, not higher. But even so, that will not remove the attention from what lies ahead and the danger of Groundhog Day as we approach the budget later in this year, with many of the issues we talked about ahead of yesterday and ahead of last October, again being talked about later this year, about how you get the growth, how do you get the fiscal numbers under control, and what levers does the Chancellor then have to pull. Over to you, Tom.
Thank you very much. Very interesting indeed. So I was just going to talk about, first of all, some of the changes that weren't announced at the spring statement, and there weren't that many rumoured in advance. As you said, the aim is really for the budget in autumn to be the main event where potential tax changes are announced. But nonetheless, there were rumours that the ISA allowance might be affected, particularly the cash ISA. That didn't happen, of course. So for those that were looking to put £20,000 into a cash ISA, they can still do that. There was also talk of the income tax bands being frozen for, say, another 2 years rather than starting to increase from 2028. Maybe that'd be pushed out to 2030. So that wasn't changed either. So of course, it could still change in the future, but you could take that as a positive as well. But seeing as there weren't that many changes announced when it comes to personal tax at the spring statement, I thought I'd then go back and look at what was announced at the most recent budget. And there were two main things there from a financial planning perspective, which I'm sure everyone is still digesting. And those were changes to the inheritance tax treatment of pensions and the increase with capital gains tax rates. That one, I would say, the second one, capital gains tax, was more limited in its effect because you had to pay capital gains tax before. Now you'll pay slightly more. And actually, there was lots of fear beforehand that capital gains tax rates would be equalised with income tax rates, and that didn't come to pass. So I think many breathed a sigh of relief, actually, that whether there was a negative change from a tax perspective, it wasn't as bad as it could have been. But I think the changes to the pension tax treatment on death will be the much bigger one that will certainly affect people's plans. And we've had lots of questions at Netwealth about what does this mean? What should I consider now? And how does this affect my retirement? And it's quite an interesting one conceptually, because for most people, they will actually use their pension as a retirement savings vehicle. They'll use that to provide an income. And if you do that, and if that was your plan, then there isn't actually much of a change. It would only be if you were to pass away prematurely that you'd be negatively affected by the changes that come in from 2027. But there were, of course, plenty of other people that were using their pension as an estate planning vehicle. They were choosing to draw down upon other assets, such as their ISAs or their general investment accounts. So for those, that is a big change now, because their whole strategy no longer works in the same way when there's 40% inheritance tax on their pension assets. So in summary, just to reiterate on what we talked about at the time, I think for many people, the big change will be starting to make use of gifting, potentially exempt transfers. So that might mean, instead of thinking about your pension purely as an estate planning vehicle, you'll see that maybe as the main source of drawing your income in retirement. And then what you might do instead is gift liquid assets you have now. Of course, that relies on some careful planning, working out how much you need to live on yourself, working out how much of your overall asset base is excess, you could say, is surplus to your actual requirements. Not always easy to do, because of course you need to factor in inflation, how your spending profile changes, how tax changes depending on drawdown strategy, and of course investment growth over the period. And it could be quite a long period if you've only just retired. But nonetheless, that will be one of the only ways really to replicate what was the case prior to that rule change. There aren't many other ways beyond making gifts now of avoiding inheritance tax entirely. And of course, that rule could change in due course, but we can only work on what we know today. I think other things to bear in mind, particularly now, this has always been the case, but there are also rules like the gifts out of regular income rule that lots of clients aren't aware of. And that's where, if you can demonstrate that a gift you make to your children, say, but it can be anyone, if you can demonstrate that that is from regular income and it has to be taxable income, then that gift is immediately outside of your estate. So that can work quite nicely with pension income because it is taxable. You can set it up so it's regular. And as long as you have bank statements or other records to demonstrate that it's regular income, it's gifted, then that's immediately outside of your estate and you don't even need to survive 7 years. So I'd expect to see that sort of thing to come to be used more often. And then one of the other things I wanted to talk about, again, not directly affected by the spring statement at all, but as it is nearly the end of the tax year, I thought it was certainly worth talking about, were just some things to think about as we get to that stage, some deadlines that need to be hit, and allowances that could be not used if you don't make the contribution in time. So of course we have the ISA allowance. We might talk a little bit more later about potential changes to those, but as things stand, as I touched upon, there's £20,000 you can pay into an ISA, whether that's a cash ISA, whether that's a stocks and shares ISA. That's a use it or lose it allowance, and not just for yourself, but if you're married, for your spouse. If you have children, it can be very important to use their allowances as well. Often children can't afford necessarily to use it themselves, particularly early in their career, but you can make a gift to your child and they can then use that gift to fund their ISA allowance. And you have junior ISAs as well, JISAs, and that's £9,000 a year to bear in mind. So that's quite an obvious one. Pensions is another big area of tax allowance that you can use each year. Slightly more complicated, or quite a lot more complicated actually, because you can carry forward allowances from the previous 3 tax years, but you also become constrained on your allowance once you become a particularly high earner above £260,000. So it's not as easy as just knowing the allowance is £60,000 and making that contribution every year, but that is the allowance in a given year for most people. So not quite use it or lose it with the pension allowance, because you can go back 3 years, but still you would lose the 3rd year. So there is still a bit of a deadline there. And people often asked, actually, with the changes to pensions announced at the last budget that I touched on earlier, is it still worth contributing? There are various other caps and allowances that have come in with pension rules. So there was the lifetime allowance that no longer exists, but now we have the lump sum allowance, which is the maximum amount of tax-free cash you can have, which is £268,275. Despite all of these changes, I would say they're still a very, very attractive vehicle, and most people should still top up their pension when they can. So not everyone will be able to. They might have stopped working. They might not have enough spare cash to put into their pension. They might be a very high earner and then they can only put in £10,000. But for most people, it is still going to be worth doing, because of course you get tax-free growth, and up to that cap I mentioned, you do get tax-free cash as well. And of course, for 2 more years, it is still outside of your estate. So that will change, but in the meantime, it's still a useful benefit to have. And then the final thing approaching the end of the tax year worth mentioning is capital gains tax, and general investment accounts are usually how you would go about using allowances there and mitigating tax where you can. So these allowances are far less generous than they once were. You have a £30,000 capital gains tax exemption each year. You have a £500 a year dividend allowance. You have to use these in the given tax year. So if you are able to, certainly worth using those as well when you have taxable investments. And then I just wanted to touch finally, before we move on to some questions, on general planning considerations, because there's sometimes you get periods where lots of tax changes happen. Sometimes you get periods where not so much happens. But I think it's really important to focus on the things that are always relevant. And at Netwealth, we talk about controlling the controllables. If you've attended other Netwealth webinars, I'm sure you've heard us say this before, but they're more valid than ever. And particularly as taxes generally across the board increase, and that seems likely, whether it's a wealth tax or something else. These key points can really make you get the most of your asset base over time. So you've got being invested rather than holding too much cash. That's really important. Even though interest rates are higher now than they have been, they were 5 years ago, as Gerard touched on, they are likely to come down. And of course, over the long run, it is very likely that you get a much better return from an invested portfolio than you would from cash. So you should always hold some cash, but not too much. You don't want your cash not working hard for you, having inflation eat away at the purchasing power. So that's one of the most important points. And lots of people are quite attuned to this, but sometimes people, out of inertia or just nervousness with markets and what's happening with Trump, which we'll touch on later, they might think, actually, I'll just sit in cash. But if you do that for too long, your purchasing power will decrease and you won't get as much of a return as you would have done. So that's one. The next one's diversification, which I guess you could say is somewhat related to the first point, but it's making sure you don't have all of your eggs in one basket. And it's very easy, particularly for a retail investor, DIY investor, to look at what's performed best over the last 5 years and put money into that, expecting that to continue. If you'd done that very recently, you'd probably have a lot of money in US tech, companies like Tesla, which have done particularly badly recently. And of course, that type of concentrated strategy can work well, but over the long run, we know you get much better risk-adjusted returns by being diversified, by having different drivers of return in different periods, knowing that you're not always going to pick it accurately in advance. You get some periods where bonds do well, some periods where commodities do well, like gold and oil and gas, but then other periods where tech companies do well. So it's important to have an appropriate blend. And of course, that applies to geographic regions and countries and economies as well, because naturally they don't always do well at the same time. The next point, which we've touched upon a little bit already, but it's making sure you use tax allowances and exemptions where possible. So again, some of these are quite obvious. It's using your ISA allowance, it's using your pension allowance, but it's also being very careful, particularly when retired. We've had questions about the implications of some of these announcements for pensioners, but it's about using your income tax band, say, appropriately when you're drawing income from your various account types in retirement. Because often we see at Netwealth, clients might have a pension, but they also have a general account, they also have ISAs, they might have a buy-to-let property and rental income. And it's looking at each of those accounts types, how they're taxed when you make withdrawals, and how you pay the lowest blended tax rate across your retirement. So not trying to minimize tax today and building up a large tax bill for later, but making sure you pay a fair, low rate across the entire length of the retirement. And sometimes it's not immediately obvious what that is, because you might think, for example, it's good to avoid tax today, so I'm not going to take pension income. But then that might mean with fiscal drag, with tax bands staying as they are, and they might increase one day, but it doesn't look like that'll be very soon. It could mean that you're building up more pension income to come out at higher rate tax if those tax bands stay low.
The fiscal drag is interesting because the Chancellor didn't make any budget or tax changes yesterday, but in the autumn, she was keen to not continue with what the previous Conservatives had done. The Conservatives had frozen the tax bands, and people were brought through fiscal drag into the highest tax bands. So they didn't increase the allowances in line with inflation. Last autumn, at the end, for the last 2 years, at the end of the forecast horizon, those tax allowances are going to go up in line with inflation. There was always an outside risk if she felt needed to. Yesterday, she might reverse that. So it's possible come the autumn that those allowances might once again further out not go up in line with inflation. So you get pulled into the fiscal drag. Can I ask a question coming back to pensions? Should the pension, given its relationship to your sort of inheritance tax, should that still and always be the last thing you draw upon or not?
I would say not, certainly not by default. So it can be, and that's quite an interesting point actually, because at first glance, the changes announced at the last budget, so pensions coming into your inheritance taxable estate, it doesn't necessarily mean there should be a change, because you do still retain control of the assets if you keep your pension there. So if you're not happy to make gifts, then you may well just leave things as they are. And then maybe you do touch it last, because assets within the pension do grow tax-free. However, lots of people, particularly when they were thinking about inheritance tax, as you know, that was probably the average person who has children and does have inheritance tax in mind, at least to some extent, then they now have a much harder decision as to whether they do really need to retain control and keep those assets in their pension, or whether they are going to become more willing to make gifts to their children or somebody else. And if you do want to make gifts, then it is going to make sense to take some money from your pension to fund your own income and gift other assets. So I think for a lot of people it is really going to change their plans, and certainly anybody that was thinking almost by default, I will just leave my pension there and forget about it, that really should change. And again, the only exceptions probably those that just absolutely couldn't countenance giving up control of those assets, but then they're paying quite a hefty price for that control now. The 40% inheritance tax.
Interesting.
Great. So I was just going to say one thing I missed earlier, actually, when thinking about the end of the tax year is charitable gifts. And that's another way of reducing your income tax bill this year if you make a gift. So that's another thing that could be missed if you were planning to do that. Just the final thing on controlling the controllables beyond drawing down from your accounts tax efficiently, thinking about the order of which accounts you take money from is keeping fees down. Now, of course, you need to pay for a level of service sometimes. You don't necessarily want to have the very, very cheapest option, which would be doing everything yourself and potentially running the risk of missing things, or maybe not being diversified enough, as I touched on earlier. But generally speaking, you can find lower fees for a given level of service. So it's really important to be mindful of that and make sure that you're not letting too much of your gross return roll up to your investment manager or your advisor. And again, in any given year, that can seem fairly insignificant, but a 1% fee compounded up over, say, 20 years can lead to an enormous difference.
1% fee over 10 years is 15%. I know, because you're far too humble, because Netwealth is one, if not the lowest, but one of the lowest fees out there. And the performance is pretty good as well. But I know the data shows 1% saving per year is quite significant over that 10-year period. That's
it. One way of looking at that, it's more assets to pass on to your children. Another way is if you're not quite sure whether you'll have enough assets to pass on, it could extend the length of your retirement, another 5 to 8 years. Of course, it depends on what the fee difference is exactly and what.
Or keep working.
Exactly. Exactly. Controlling the controllables is really important, and to help you do that, of course, planning is important as well. So it's of course very, very difficult sometimes to find time to do this, but particularly with that point on pensions in mind, thinking about in advance, how much can I afford to gift? When shall I do this? How long am I going to have to sort of educate my children almost in terms of looking after this responsibly? But the sooner you do that, the sooner you can start making gifts. And then the sooner that 7-year clock will start ticking down. So having a plan and being mindful of those points is really, really important. Great. So wanted to move on to some investment related questions, if I may. And I think you might be the best place for some of the first ones on Trump, on tariffs, lots of concerned clients. So why don't we start with tariffs and how you think that might affect, I guess, the economy, but also if you think about, say, a net wealth investor of a diversified portfolio, what some of the impacts there might be?
Yeah, tariffs are fascinating. Normally, it's a case of good economics is good politics. But tariffs is one of those bizarre areas where the politics and the economics pull in different directions. For instance, you might want, as is the case in America, to impose tariffs, and politically that might go down well. But we know from history that even the country that imposes tariffs suffers. More bizarrely, and often people don't get this, is that if you're the country hit by tariffs, naturally, your temptation is to respond with higher tariffs, like Mark Carney in Canada. And politically, that might sound like the good thing to do. We're tough. But bizarrely, economically, that's the last thing you should do. Because if you impose tariffs are a tax on imports. And therefore, if you impose tariffs, you're putting a tax on your own consumers, higher interest rates, high inflation and probably higher interest rates. And you certainly are going to hit growth. Britain actually, bizarrely, in the late 19th century, might seem like a long time ago, the long depression, 1870 onwards, the rest of the world all got engaged in beggar my neighbour policies. Someone put tariffs on, someone else responded. We didn't. Obviously other factors as well, but we benefited. So bizarrely, tariffs pull in different directions in economics and political terms. The OBR, the official forecaster yesterday, had 3 different scenarios on tariffs. If tariffs were imposed by America on Mexico, Canada, and China, no one else. If America imposed tariffs on everyone, and also if America imposed tariffs and Britain responded. And so they basically showed that tariffs do impact you, but let's wait and see. Importantly, Britain is a service sector economy. We do export some goods to the States, but that's small in relation. Our second biggest goods export, though, is cars. So higher US tariffs on cars do impact us. But largely speaking, the UK should be not too exposed. Obviously, if President Trump imposes tariffs because countries impose VAT on American exports, because the way the Americans see it, then we do get caught up. Last week, the business secretary was in Washington on the Tuesday. Last week on the Monday, Ambassador Mandelson wrote a well-received, if you read the new US papers, well-received article in the Washington Hill magazine. So the UK is doing a lot to position itself, but we will be impacted. But tariffs add to price pressures and impact negatively trade and growth. How does it impact investment? You still need to be thinking diversified and global, but also at the same time, the UK might be slightly mitigated against some of these pressures, and the UK might be seen slightly as a safe haven against this backdrop.
Yeah, and there's a slightly more specific question that I might be better placed to answer on that. So should clients consider their strategy and their risk level? And I would say not with regard to any individual policy like that, because as much as it will have impacts, as Gerard talked about just then, our investment team, of course, manage each portfolio behind the scenes to take into account those sorts of things. And as much as tariffs are certainly attracting the headlines now, they are one of many factors that go into what affect economies, let alone individual companies and individual sectors. So certainly not worth making drastic changes and doing something like moving from an equity-based portfolio to a cash portfolio, or even just downgrading your level of risk. Because if a higher level of risk is right for you because you have a long time horizon and because you're willing to withstand volatility, then that probably remains right for you. And of course, if your circumstances change, then maybe not, but that's your circumstances, not the fact that Trump's talking about tariffs of varying levels. But related to that, Gerard, I wondered what your thoughts are. Pretty related, a little bit different. It's the fact that Trump, some of the comments from his team are considered quite anti-European, shall we say. And of course, we've seen a bit of a reversal in terms of markets away from the US to, say, European equities. How do you see that playing out? Do you think that will have an impact on, say, the UK?
Okay, I think we need to differentiate between defence and other non-defence issues. In terms of defence, successive US presidents, not just President Trump, but his predecessors as well, have tended to criticise European countries for not spending enough to fund NATO. And therefore, they've always implicitly said that Europe has been free riding, not Britain or France usually, or not one or two others. Trump has been more forceful, that's come to the fore, but is now having the impact of forcing European countries to step up and spend. Obviously, there's the issue there linked to Article 5 of NATO and whether one can rely on America in the way in which we could before. So there's that aspect, but we have to see how that plays out. But certainly it's having, you might say from a US perspective, a desired impact in forcing European countries to spend more. Obviously, the US-Russia relationship, people can follow that for themselves. When we come on to non-economic issues, or non-defense issues rather, it's more complex. It's premature to talk about the issue at the moment. But when you follow things in the States, it's more because their focus is switching more to Pan-Pacific. And when you look at the world economy, it's something to be relevant for in terms of our investments as well. We need to look at the atlas from a different way, with India on the west and America in the east. And it's the Indo-Pacific is where the attention is. Now, in economic terms, China is the big threat to America. In defense terms, it's the big challenge. So I'm not convinced yet it permeates from defence issues into the wider debate. But obviously some of the recent comments are probably unsavoury at the very least, we should say. How is the UK? The UK has manoeuvred itself. Being outside the EU provides us with a big opportunity in terms of AI and technology, because we have the regulatory autonomy. The EU has taken a hard line. So we have the ability to be flexible within that. And I think that regulatory autonomy becomes very key. Naturally, Britain wants to have a sensible working relationship with the EU. And we also want to have a sensible working relationship with the States and China and other countries. And it appears to be the focus that Prime Minister Starmer has taken at the moment. Let's see how it works out from here.
Yeah, I think the China parallel is quite an interesting one, actually, because there's lots of sort of concern at the moment in Europe and the UK about, the US not being quite as friendly as they once were in various ways. But if you look at China, there's been various ups and downs in terms of how friendly the relationship has been with the West over, I guess, since the war, but maybe like the last 20 years, say. But despite that, China has always remained an investable market. It's been a bit more volatile than other markets, but it's not meant that you have to turn away from that entirely.
No, obviously there's been lots of different factors at play. In terms of economic growth, China is moving from high sustained 10% plus rates of growth to now much slower growth and more volatile growth. Maybe 5% this year, slightly lower in future years. In terms of UK-China, the economic and financial dialogue took place in Beijing earlier this year. The foreign secretary has been out to China, the Chinese foreign minister recently. So what we need to do with China, it seems to me, is in some respects differentiate between the political security type issues versus the business, trade and finance issues, and have a clear red line. But you're right. So it's a more complex environment. What it means in terms of investment, it means that in terms of yesterday's numbers, the UK is far more vulnerable if there's shocks globally. But from an investment perspective, one still needs to be sort of mapping out and on top of these issues in different parts of the world and still being diversified given where future growth and trade is coming from. Certainly.
Excellent. So moving on to a slightly different topic, looking forward to this year, might not come in, but that's wealth taxes.
Wealth tax, yeah. Yeah, when you think, just to reiterate the point, when it comes to debt, growth, reform, austerity, tax, borrow. Ideally, you want growth or reforms, productivity increases. Because the Chancellor yesterday tweaked the rate of growth in departmental spending, and because the rate of growth in welfare spending was also impacted, there's lots of issues now about surely we should be looking for other areas, and wealth taxes. I would be against wealth tax. I think it's important to stress that not only is the UK already highly taxed, the UK sensibly has a very progressive income tax system. So the top 10% of earners roughly pay 2/3 of income tax. The top 1% pays probably about 31, 32%. So we have a progressive tax. We also tax property very heavily, although we do it in a stupid way through stamp duty, which hits a turnover. But a wealth tax, in 1990, 12 OECD countries had a wealth tax. They're now down to just 3. And in those 3, Norway, Switzerland, and Spain, thresholds have been changed and taxes reduced. And the reason many countries have pulled away from wealth tax is that it's like many taxes. Once you introduce it, things that are mobile move. So if the very wealthy move, then what happens with the tax is it starts to be imposed on those who are in work or the middle classes. There is a big piece of work from the LSE by Advani et al. I think it's Advani, Chamberlain and Summers looked at wealth taxes. I read it the other week. It's a lengthy document, 110, 120 pages. But even with a 1% wealth tax, they say one of their downsides is that 7 to 17% of the tax base is lost. And that is people go, they move. And you don't really, the trouble about a wealth tax is it sends a very negative signal. It makes the UK look very unattractive for inward investment and for investors or wealth creators. And these are mobile and they can move elsewhere. In that same research, it showed that if you imposed it at a high level, say over £5 million, 85% of those assets are business assets. And what you've seen in Switzerland and Norway, who have wealth taxes, is the real problem about encouraging entrepreneurs to set up businesses. So these are real big challenges. Dennis Healy back in the 70s said, after Labour had been in power from 74 to 79, he said, quote, this is a really good quote, "We're committed to a wealth tax, but in the last 5 years, I found it impossible to draft one which would yield revenue to be worth the administrative costs and the political hassle." Mm-hmm. Actually, at the same time, Ireland in 75 imposed a wealth tax. They stopped it 3 years later. Taxing areas that are mobile is difficult. And people talk out mega wealth, but what you really end up doing is sending a very negative signal. But what it comes back to is that wealth taxes are being put forward as an easy option. They're not. They have consequences. And what we really need to do is address the underlying issue, which is to get growth up and to keep public spending under control.
And I think even if it was possible to put in a wealth tax, that's not necessarily going to be the silver bullet that people want anyway. As you touched on, the tax take as a percentage of GDP is pretty much at a post-war high, as far as I'm aware.
Yeah.
We already have lots of taxes that.
Well, on those taxes, because even that Advani reports that people keep citing, they said the best way to have a wealth tax is to make the current wealth taxes work better. So, given that all the viewers should be sort of thinking ahead about planning ahead of the budget, what possibly could happen on those existing wealth taxes, capital gains, etc.?
That's it. Capital gains tax, stamp duty, inheritance tax can certainly be thought of a type of wealth tax as well.
Yes.
But yeah, and that's partly why pensions have been brought into the inheritance tax regime. So yeah, lots of things to think about.
So it's planning for all scenarios almost.
Which brings me to my final point, actually, which was just how would you sum up what we saw yesterday, or what clients should think about moving forwards? Yeah,
well, in recent years, the challenge has been that Britain has been a low growth, low productivity, low wage economy. The OBR is maybe optimistic relative to the consensus about growth prospects. Despite revising down growth this year, they think the economy has the ability to rebound in future years. But even after that, and even if we achieve that, what we really have now is that UK, like other G7 countries, is a high debt, high spending, high tax economy. Now, clearly, as the population gets older, there's a need to spend more on pensions and on health. But at the same time, when you look at public spending, there's clearly a need to have targeted spending that achieves what you need in terms of welfare, etc. But what we have is a complex background, and very much it comes down to, unless you get the economic growth, then some of the difficult challenges that were avoided yesterday will come back to the fore. These are implicitly political issues, but really what you want is to actually have higher economic growth in the UK. Maybe as an economist, the real positive from yesterday, and this is very economic, is that the OBR gave the thumbs up to planning reform. Often at these events, it's always, where can the government spend more? Where can we see more spending in the economy? Economists collectively, and it's always dangerous when economists agree on something, I admit, say it's supply side measures that are necessary, measures to boost innovation, boost investment. And planning reform yesterday was implicitly accepted by the OBR as a big positive. So as cautious as it is, we might yet have positive things ahead. But for the next 6 months, the economy is vulnerable to events in the States. It's vulnerable to a lack of momentum here at home. And if growth disappoints, then we're going to see a very difficult backdrop either in the autumn budget or in the big fiscal event next year. So plan ahead.
Excellent. That brings me on to what I was going to finish on. So certainly plan ahead, and to be a little bit more specific about what that looks like. It's looking ahead to, again, particularly those approaching retirement, but there are lots of things you can plan for if you're not that close to retirement as well. But it's looking at how much of your asset base you're likely to need for yourself. So the budget, of course, means that if you were going to rely on your pension as an estate planning vehicle, that's no longer going to work, or not from 2027 at least. So it's going to be really important to see whether you can afford to gift other assets that are in your estate to children, to whoever you want to gift them to survive 7 years, and then to reduce that inheritance tax liability ultimately. So that's going to be a key planning point. But even for those without children, Gerard mentioned lots of vulnerabilities there. And although lots of them will be out of your control, if you have a sensible plan, you'll do all that you can to mitigate against that. So it's thinking about cautious assumptions looking forward. What might inflation be? How much might I spend? Probably adding to that a little bit to give yourself a buffer. Thinking about how long you'll live for, probably extending that by a few years to give yourself a buffer as well. But the sooner you do that, the better prepared you'll be to mitigate some of the impacts Gerard touched on there.
Yeah, plan for the worst and hope for the best.
Exactly.
Is that it?
Exactly.
But hopefully there's some positives to come through.
Exactly. Well, thank you all very much for joining us today. If you have any questions at all, please feel free to send those through at advice@netwealth.com. Otherwise, enjoy the rest of your day.
Thank you. Bye.
Right.